Welcome back, investors, to Ticker Time News. I'm Adam. And before I dive into what happened in the market today, why it happened, and what to expect next week, I wanted to address a question from one of our investors on Patreon. Why does the technology sector, XLK, and the QQQ underperform when the 10-year Treasury goes up? Well, first, it's important to remember that the 10-year Treasury is sensitive to two things. Number one being growth concerns. If the economy is struggling, if the economy is slowing down, if we're in a recession or heading into a recession, or the recession is deepening, that can cause the 10-year yield to rise because investors feel that their money is safer in a long-term bond than it is in the equity market. And that's something that can happen. Or investors can take their money and put it into other secure assets, maybe leaving some in cash, maybe diversifying it into other safe assets, leaving the actual yield of the 10-year to rise, causing technology to suffer. And then inflation. If inflation is expected to go up, that can cause the 10-year to rise as well. And right now, we had a lot of Fed speak this past week, especially on Thursday. And I think a lot of that information got digested today, and that's what caused today to drop off. So anyone who watched yesterday's live stream, you were well aware of the Fed speak that took place yesterday. And one of the concerns from one of the Fed presidents, not Powell himself, was that a 75 basis point rate hike seemed like the right move when they have their meeting in September. And remember, their meeting is on September the 20th and 21st. So on September 21st, we will have the answer to whether or how high the rate hike will be. So inflation concerns can cause the 10-year to rise. One other note about that inflation concern. Another Fed president this past Thursday said that, hey, wait a minute, it is too early to celebrate inflation. It is too early to celebrate peak inflation because remember what happened in March. We got a lower reading, 8.5%. The next couple of months, inflation rose. Could that happen again? We get a lower read, 8.5, the exact number from March. Could September's number be higher? Could it accelerate from 8.5 and go up? Or a couple months from now, could inflation tick back up again? Yes, because the big question is, how is oil going to react this winter? If there is really oil shortages come this winter, that is going to affect inflation and cause it to go up, which would then, of course, cause the 10-year to go up. So a couple of things are wrapped into the movements of the 10-year and how those bonds react. And another thing to point out about the growth concerns, we have got a ton of growth concerns on the table to worry about, and that can affect the 10-year yield. Now, on the screen here, you see an orange line zigzagging and the red and green candles. The red and green candles represent the QQQ. Okay, no, my apologies. I didn't put let me go to the QQQ. I had XLK up, which was the technology sector. Here is the QQQ, which tracks the NASDAQ. And you can see here many times when the 10-year goes up, well, it pressures the QQQ in the technology sector to go down. It pressures the NASDAQ to go down. However, it's not always the case. Let me show you. First, recently, I'm going to draw a line right here on August 15th. That's when the market kind of hit its peak from the nice rally that we'd been on. And if you look at the 10-year going back to the very beginning of August 1st, the trend for the 10-year has been rising, right? Well, what has the market been doing from August 1st, or QQQ? What have the Qs been doing since August 1st? They have also been rising up until that August 12th moment in time. So let's clean this up here a little bit, and let's go back to August 15th. From there, the 10-year goes up. It continues its trend going up, but the QQQ is trending down, right? And the 10-year had a big spike today, causing kind of a big spike in the Qs. But if we look here, the SPX, it was down 1.3%. The SPY was down 1.3%. The QQQ was down 1.9%. So it did underperform, but the IWM was down 2.1%. So the Qs, which is technology mainly, outperformed small caps because the IWM, it tracks the Russell 2000. So the Qs were kind of in the middle of it today, literally in the middle of the S&P 500 and the Russell 2000. So it doesn't always work out that when the 10-year goes up, the Qs come down. But it does so frequently that it's usually front of mind for many people. Excuse me. So let me back up a little bit further, okay? Let's go back to, let's say right here, July the 1st, all right? That was a big dip right here for the 10-year yield. From July the 1st, from that dip, the 10-year went up. What did the QQQs do? The Qs also went up, right? So another time where that correlation isn't very strong. I mean, they were literally moving together. So let's look at another point. From this point here, this tip, the Qs from July the 8th, they go down, okay? If we look here, July the 8th on the Qs, what does it do? It goes down. So they're moving in concert with one another, okay? Let's do it one more time. From the 15th of July, the 10-year goes up. What do the Qs do from the 15th of July? The Qs also go up. So they were literally moving in concert. And here we have again, 10-year drops. We'll just continue this. The Qs drop. Now here, the 10-year dropped really hard, but that's when the Qs rallied really hard. So don't let noise shake your foundation. Just because the 10-year goes up doesn't necessarily mean that the Qs or technology sector goes down. It's not always like that. There's a lot of noise out there that says it is, but I'm showing you literally here on the chart that it's not always the case. All right? Okay. So let's talk about this a little bit more. But first, real quick, I want to take us off of the Qs, and I want to go to XLK, which is the technology sector. And we're going to line it up and look here, and it's basically the exact same movement as the Qs. Not 100%, but pretty much. So if we look back here, the 15th of August again, the 10-year has gone up. The technology sector moved sideways and then went down. It went down today on a strong move up. Now, I'm going to tell you why the technology sector and the Qs go down when there is a strong move up in the 10-year. But first, I just want to make sure you're clear that there is sometimes noise out there. And if we look back here at this big dip on the 10-year, going back to August 1st, both the 10-year and technology pretty much had the same trend line up and to the right on the chart. So don't let the noise beat you up and make you think that, hey, every single time the 10-year goes up, the Qs, the technology sector doesn't. And you will hear it a ton of times. Talking heads will get on mainstream media and they'll say, oh, the 10-year is going up today. That's why the Qs, the technology, the NASDAQ, that's why it's going down. And they don't really know their A from their Z, okay? Not saying that I do every time, but at least I'm giving you some context and some evidence to back up what I'm saying. Now, tech stocks typically can lag growth stocks in certain times. And that's why I've been talking about that metric lately on the live stream, talking about how growth stocks are doing compared to value stocks. Sometimes when growth stocks get beaten up so bad, like they have at the first half of 2022, then growth stocks can outperform and do better than value stocks when the growth stocks valuation has been beaten up so bad that they're almost on level playing fields. Just another little note about what's happening when the 10-year is moving versus when technology is moving. Now, higher rates means that earnings, so higher rates in the 10-year can mean that earnings a year from now, 2 years from now, typically some longer time frame in the future, are worth less than they are today. As I guess I should frame it, as higher yields typically means a greater discount on future profits. For example, the Fed funds rate. As the Fed is raising rates, that means it costs more to borrow money in the future than it does today before the rate hikes go up. That means there is the profit that is generated a year from now when rates are higher means that the profit is actually smaller when you take into account the hike in rates compared to today. It's really, really hard to put it in a real simple term for what I'm trying to say, because it just sounds, especially to newer investors, it sounds like gibberish, financial gibberish. But think of it when you're borrowing a car. When you buy a car and you borrow money to buy that car, you'll have an interest rate. When you make your monthly payment, some of it goes to the interest rate, to the bank, and some of it goes to your principal to pay off your loan. Okay. Say in a year from now, your rate that you borrowed on went up. So now your monthly payments, they're the same, but the amount you're paying the bank has gotten bigger, while the amount that you're paying to pay off the actual loan has gotten smaller. I guess that's a better way to show how future earnings can be worth less when rates are higher in the future. So that's another reason why the 10-year can, discount or bring the valuation of the tech sector down with it. So when markets start to discount those profits, then the market, or the stocks, the Qs, the NASDAQ, they will start to head lower. So the valuation of the company gets brought down in line with what the rate is in the future. And the stock market is always forward looking. Now, I hope that helps to kind of clarify a little bit here on why the QQQ will go down when the 10-year goes up sometimes, right? Because I showed you how that's not always the case. Most of what you hear from talking heads on mainstream media is noise, and you got to cut out the noise. Just because the 10-year goes up, it does not necessarily mean technology goes down. And we prove that here by looking at the stock chart. Now, today, that happened to be the case. And I think the majority of today was what happened yesterday with all the Fed speak that we talked about at the beginning of this live stream. If the Fed is saying, you know what, inflation, don't applaud yet, it could go higher, well, that's going to send the 10-year up. Also, the Fed saying, well, 75 basis points seems like the right move in September. Well, that's going to hurt the market, because the market, this entire rally that we've been on, and let me take the 10-year Treasury off of the chart, and I'm going to go back and I'm going to look at the SPX, which is the ticker that I use for the S&P 500. This rally that we have had has been front-running a Fed pivot. I've been saying for a month now, since the last FOMC meeting, that there will not be a Fed pivot in September. It is too early. Inflation is still too high. So if the market rallied thinking there would be a Fed pivot sooner rather than later, what's going to happen to the market now that they see the reality that the Fed will not pivot in September, and they could be raising rates by 75 basis points? The market will go down. So the front running, this big rally, it's been great if you've been on the long side of it. It's obviously beating you up if you've been on the short side of it. But overall, it got too hot, too quick, and the expectations of a Fed pivot, I don't know why the market was in fairyland or dream world or wherever the market's head was, thinking that, because it's not going to happen. Plus, the market had gotten so overheated. It's like if you're driving an old beat up truck. You're driving that beat up truck, and all of a sudden you're running low on antifreeze, or maybe you don't even have any antifreeze in your radiator. You're just pouring in buckets of water to try to keep the motor cool. but that motor had gotten too hot. Steam is going everywhere. You're low on water in the engine, and it can't cool that motor down, and the motor overheats. That's where the market was. Plus, the market ran into, at least on the S&P 500 with the SPX and the SPY, ran into a trifecta of resistance points. So the market's got to cool down. It's got to digest all of that information that it has received over this 2-month rally. But I will also say, like I've said before at the last FOMC meeting, until September, there's no big catalyst that could bring this market down. It can chop around and move sideways, that's for sure. But once we get into September, I believe it's the 3rd, 13th, and 21st. Those are the big economic data drops, and they will be catalysts to move this market. The first one is the jobs report. The second one is the CPI report. And the third one is the FOMC meeting. They will be big catalysts, and they will move this market one way or the other. So right now, the Fed Watch tool is still leaning. I checked it before I went live. Yesterday, it was about 60% saying it would a 60% probability or 60% chance of a 50 basis point rate hike. That has now dropped down to about 55 to 52%, while the 75 basis point rate hike has gone up a little bit. So we're almost even, an even split on those saying a 50 basis point rate hike versus a 75 basis point rate hike. Okay, let's see here. Yeah, I hear that a lot. Yeah, talking about the pundits, talking about the 10-year, always, reacting with the NASDAQ and technology stocks. Definitely a lot. Absolutely. Finally caught a live stream today. Awesome, Dave. Would you mind looking at Microsoft? My position got called away last week. I have a entry point to start buying again around 260. I hope they keep it at 75 rate hikes. I personally hope they do a 75 basis point rate hike too, because even though it's an 8.5% inflation reading in the CPI report, that's still too high, and it is still much higher than the 2% average that the Fed wants inflation to be at. So, one more thing to point out about Fed speak. Next week is the Jackson Hole meeting, and it's where central bankers, policymakers, academia, economists, they all get together for this meeting. And I believe it starts on the 25th and it goes through the 27th. On the 26th, Jerome Powell will speak. And what he's going to say, at least his prepared speech, is already out there and you can read it. I read it myself. He's very neutral when talking about the economy, when talking about inflation, but he does mention the fact that the inflation is not near their target rate of 2%. So to me, the speech sounds very neutral. It doesn't sound any more hawkish, any more dovish than what things he's already said. So if you just Google search Federal Reserve Jackson Hole, 2 words, there's a link you can click on, and then when you click on the actual meeting, there's an itinerary. Just go down to you see Jerome Powell, click on it right beside his name. You can click and see the speech that is already prepared for him to say and read it yourself. So you've got a heads up on this. As a matter of fact, I'll share a link to that. How's it going? Love your show. Awesome. Glad you're here. So I'll share that as well. So you guys can read it if you want to. All right. Before I get into this market, let's talk about Microsoft real quick, just to answer the question. We're looking for 260. MSFT is the ticker symbol for Microsoft. And you want to start buying again around 160. So let's see how Microsoft is doing here. And actually, I need to pull up one more thing because I don't think I have it here for Microsoft. All right, it's loading. All right, short term here, obviously the whole market kind of has this setup right here. The blue line, it's hard to see, but this is the 5-day EMA, and it's been going, you know, kind of up like this. The candles have been staying above it. That's a very bullish bias with that. But since hitting the 200-day moving average, the candles and the 5-day EMA have kind of been sloping over like this, where the candles were on top of and in front of the 5-day EMA, but now the candles are below the 5-day EMA. So it's just like the 50-day average, 50-day moving average, bullish above, bearish below. So there is a bit of a bearish, short-term bearish bias in Microsoft right now. And I think this rejection on the 200-day moving average, it's a tough one for Microsoft. But let me do this real quick. Microsoft. So we've got 299. This isn't going to be exact science or perfect. Okay, did I not get it? There we go. All right, so the purple line here, I did not adjust this for Microsoft, but this is the weekly expected move. The top end of its range was 299.3. So we'll just leave it right there. That's in the ballpark. All right, so the bottom end of the range was 284. 284.4. So you can see here that Microsoft did finish within its weekly expected move, which is great news. Remember, the options market is right 68% of the time. You can think of the weekly expected moves, and you know, we do 35, 40 different products every Sunday. We give those out to our investors on Patreon, and it's almost like having a cheat code or a cheat sheet for the week ahead on where different equities or even the main indices or the different sectors are going to end up by close of day on Friday. And one thing cool about the Qs today, they actually bounced off of the lower end of the weekly expected move twice before finally closing right on it or slightly above it, but still within that range. So Microsoft 260, let me put a line down here on 260 and right here. And let's take a look at this. Let's see what we've got. So all of a sudden at this 260 level, which is the bottom, I'll change it to a different color. So it's not, change it to blue. So that blue line is the 260 for Microsoft. And if you look at the volume shelf profile over here, that's like the upper limit. There's, and let me get the Sharpie here. There's volume right here. It goes from about 255 to 260. 255 to 260. And then there's like a little vacuum chamber right in here where their volume is really, really weak at the price point. The next time it pops up is at 265. And if we look at 265, that does match up with the tops right here. So as Microsoft is starting to pull back down, if we have a negative week leading into September, which I originally thought that the rest of August, it could be choppy, but there were no big catalysts in the way until September. But it looks like August got overheated in the sun, and we went through a heat wave that just got everyone's brains fried, and now we got to cool them off. So everyone's stepping into the AC or getting under a shade or something, and this market may just cool off. So I'd want to see, and you can see how it has totally pulled away from its 20-day moving average and its 50-day moving average. It is very extended from those points. So this is a hot move by Microsoft. So if we are looking at the 50-day moving average, that's at 267. I believe it's 267. The 200-day moving average is kind of blocking my view a little bit. All right. So 50-day moving average is at 267. So I think there is probably a good range somewhere between 265, which remember, this area here is 265. The 50-day moving average is just 2 points above 265. So I think 265 would be a good target. But if it breaks 265, since there's like this vacuum gap of no volume, very low volume, I should say, then volume doesn't pick back up until 260, which is down here. So I think if it could hold at 265, there could be a bounce right there. But if it breaks down below 265, then there's nothing stopping it until it gets to 260. So I think your buying point of 260, I think it's fair. I think it's logical. And I think there's good reason for picking that number. And it's not just some random number. But I would be cautious about how price action reacts when it gets to the 50-day moving average. That will be key. Because if it can find support at the 50-day moving average, because remember, with the 50-day moving average, it's bullish above, bearish below. So it can pull back to that 50-day moving average. Watch how it reacts. It could slow it down where it just, kind of bounces around a couple of days before either finally shooting back off or breaking down. But if it breaks down, it's definitely going to lose that $5 difference really quick because there is no volume really between 260 and 265. So just watch that 50-day moving average. It can act like a magnet and pull price action to it. And being like a magnet, it can hold price action right there on it and keep it there for a few days, or allow it to build up some support where it can bounce off of that. So just be cautious of that area. All right, just trying to clean the chart up a little bit here. I do like your 260. I would just be cautious about how it interacts with the 50-day moving average as it pulls back to it, which currently right now is at 267. But your 260, very logical choice. It's on the upper end of huge volume compared relative to the other volume spikes on the volume profile. So there's a bunch of action at 260 down to 255, a $10 swing right there. Okay, so that's Microsoft there. I think it's entry point of 260. It is logical. It's smart. There's good reason for that price point. Just beware of the 50-day moving average and how price action reacts to it. Okay, let's go to the major indices today. Let's go to the SPX. And you're going to find a very common theme among the main indices. I do have up here in orange Federal Reserve's Jackson Hole meeting, 26th of August. And that's going to be an interesting speech. Again, I read through at least his preliminary speech that he is going to has turned in to the conference. And it sounds very neutral to me. We'll see how that changes as when he actually presents it. But the overall similarity that you're going to see is that this market got overextended. The market got hot. The market reached resistance. And then the market has cooled off. Okay. And you're seeing this kind of rollover top where the 5-day EMA has been acting as support, but it has closed below that 5-day EMA, which means on the short term, you should have some bearish bias, at least on the short term. And RSI right now is at a 68.8. Today's pullback helped to cool that down some. It peaked at a 77.8, and that's when it ran into the trifecta of resistance points for the SPX. There are 4 different gaps here that could get filled if there is a retest of the June lows. Now, there's 2 camps on this. One camp thinks that the June low was the low. There's another camp who thinks that that low will be retested. I'm in the camp of that low will be retested. One big catalyst that nobody is talking about yet is the midterm election catalyst. It will hang heavy on the market. September, October are going to be rough for the market. But then I do believe November and December should be good months in the market. That's my investment thesis, not financial advice. But take what I share, add it to your own thesis, take other nuggets of information from other places where you get your information from, and build your thesis. What do you think? Where do you think the market's going to go? How is it going to react, and so forth? So, all right, let me pull up the SPY here. And of course, the SPX and the SPY both track the S&P 500, and they both closed within the weekly expected move. For the general market, the market opened on a downbeat note and never found its footing And today was an options expiration day. I mentioned that yesterday during the live stream. So today it was a risk-off trade. And there was some global economic data today. Germany had a hot PPI, which renewed inflationary concerns. That's one reason why the 10-year moved so strong today. What if inflation isn't over yet? So the higher long-term rates, like the 10-year, acted as a headwind. While price action in meme stocks or momentum stocks, particularly in Bed Bath & Beyond, ticker symbol BBBY, offered a reality check for the market. It lost over 40% just today. Bed Bath & Beyond fell, and let me just pull that up real quick. BBBY sounds like a droid out of Star Wars. Look at this chart. Look at the price action. This thing has just been radical. But Bed Bath & Beyond also fell on the news that rock star Ryan Cohen and his RC Ventures investment firm completed the sale of its stake in Bed Bath & Beyond. So they are no longer holding any of this equity. And then Bloomberg Law reported that the company supposedly hired Kirkland Ellis, which is a law firm, to help address matters pertaining to its company's debt load, meaning the company has got more debt than it can service. Bankruptcy for Bed Bath & Beyond, or can they get this restructured? It's a big one. But this was a big reality check. Now, going back to the SPY, the S&P 500 was down 1.2%. The SPY was down 1.3%. This left the SPY within its weekly expected move, but just slightly above it. Just slightly above it. And again, like I mentioned way earlier, the SPY did actually tag that weekly expected move 2 different times today, this afternoon, before closing just off of that weekly expected move, the lower end. The Dow Jones was down 0.2% for the week, leaving the ticker symbol DIA, and let me load that here for you, leaving it within its own weekly expected move, kind of midway there. And then the NASDAQ composite, well, it was down 2.6% for the week. And the majority of that came from today. And if you look at the Qs bounced off of that lower range of the weekly expected move, but it ended up closing slightly above it. Now, the SPY, the Qs, DIA, and IWM, and the IWM is for the Russell 2000. That was the biggest loser today, and it closed just to the outside. Call from Brandy. Just to the outside of the, I'm getting a video call here. Just to the outside of its weekly expected move on the lower end. But if you look here on the IWM, it did fill the gap, okay? It filled this gap that was left open here on the big run up. So I can officially now take that out because the gap got filled. But that leaves 4 more gaps down to the June lows that could be filled. I guess leading up to the middle to end of October would be my time frame. But the SPY, the Qs, the DIA, and the IWM all closed below their 5-day EMA, setting up for a short-term bearish bias. And with the Fed speak next week at Jackson Hole, that could compound the negative Fed speak that we had yesterday. Next week could be a tough week on the market. And then mega cap stocks today and growth stocks, they drove the market lower. The Vanguard Mega Cap Growth ETF, ticker symbol is MGK, that fell 1.9% versus the 1.3% loss in the Invesco S&P 500 equal weight ETF. And then you compare this, the Russell 3000 Growth Index, it was down 1.7%. That trailed the Russell 3000 Value Index being down 1.2%. So growth was getting hit extra hard today. And I'm sure the talking heads on TV were all saying, well, the 10-year is rising pretty fast today. And I can partly understand that comment, but not totally. Semiconductors, they were also especially weak today. And it had to do with a company that I like a lot, and that's Applied Materials. Ticker symbol is AMAT, A-M-A-T. I like the company, but the material sector is starting to get behind us now for where we are in our market cycle and where we are in our economic cycle, the business cycle. What's coming up, what should be starting to outperform, is healthcare. That should be a sector that should be doing pretty well in the next 3 months, 6 months, depending on how steep of a recession we actually have. But Applied Material, it was down 3.36% today. It had a cautious commentary that accompanied its earnings report. And the company dropped, what did I say, 3.36%? And like I did earlier this week, we start at the individual stock level, then we go to the subsector, I guess you could call it, which is the semiconductor sector, ticker symbol SMH, and that's for the Van Erik Semiconductor ETF. Do weekly expected move for this one. And it landed right on the bottom end of its range. And then this helps to account for why the technology sector was pulled down today. So we go from single stock to a subsector, semiconductors, and then to the full sector technology. So I like to trace back to where did the problem start from and what was the problem in the first place? Well, it was a growth concern problem. Let's see. I have not paid any attention to Wall Street bets. Is BBBY still being pumped? Yes, absolutely. This past week was a big pump and dump, a huge pump and dump for all of the meme/momentum stocks in the market. They all ran up big starting last week, reaching their heights Tuesday or even in some cases yesterday. And then today, they all came crashing down. That's why BBBY lost over 40% today. So big pump and dump. So I stay away from them because there's no rationale, there's no reasoning behind it. It's just how high can we pump this thing, and then who can we get to be left over holding the bag? I'd rather focus on the real fundamentals and the real technical analysis. Okay, so semiconductor, ETF here, it closed again on that. It closed at 134.9, and the bottom range of the weekly expected move was 234.4. So literally about 50 cents difference. 50 cents difference. This is a cheat sheet. It's a cheat code to the market. The weekly expected moves. They're a cheat code to the market. That's why we give our investors these every Sunday evening so they know what to expect. If you would like to get them, just click the first link in the description or the link that is pinned in the live chat. Now, landing right on the lower range is just beautiful. Now, the S&P 500 sector performance. Let me pull the sectors up here. We'll look at XLK technology, and we'll see how a single company and a sub sector within the technology, which is semiconductors, all help to pull the technology sector down. Now, this is very, very interesting. And this is how I say one of the ways you can use weekly expected moves, okay? The weekly expected move, that number, it's not just pulled out of thin air. The options market, you can use an equation to come up with a number based on the options market, implied volatility, strike price, and so forth. You come up with the number, and then by close of business Friday, the indice, the sector, the equity, the stock, it should be within that range on close. Look what happened to technology. Technology ran hot. It ran to its 200-day moving average, which was above the upper range of its weekly expected move. It hugged that 200-day moving average like a Band-Aid or like a magnet, not a Band-Aid, but a magnet. And then today it fell back down and it closed literally 6 pennies off of its line. It closed at 148.11. The weekly expected move was 148.17. So it closed 6 pennies inside of the upper range of its weekly expected move. That's why these are called a cheat sheet for the market. Because whenever an equity pops out, you can expect that it's going to pull back down and fall in that range. If an equity were to break out or break down to the bottom, you could bet 68% of the time, that is, or a 68% win rate, that it's going to end on Friday back within that box, pulling itself back up. So you can go long or short based on where they're at, where price action takes you. And then using these as an example of where it should be, it's a great strategy. And that's a 68% win rate. What else is better than, well, of course, a 70% win rate will be better, but where can you find something better than a 68% win rate in the market? It is rare. Now, the S&P 500 sectors here, the 11 S&P 500 sectors, over here on the right-hand side of your screen, you can see all the red. What was green? XLV was green, which is healthcare. What did I say just a few moments ago about the market cycle and the business cycle and where we're at right now? healthcare should be one of those sectors that start to outperform over the next 3 to 6 months, depending on how deep the recession goes. The deeper the recession, the longer healthcare will outperform. I myself personally right now am starting to build a position in healthcare. Now, counter-cyclical sectors, utilities down 0.1% over here. We have consumer staples down 0.4%. And then we have healthcare up 0.3%. They closed ahead of the broader market. Notably, utilities and consumer staples were two of the only three sectors to close the week with gains. Utilities were up 1.2% and consumer staples were up 1.9% on the week. The other week-to-date gainer was energy, up 1%. Let's look at energy. XLE, energy. Energy has been hit or miss because oil has been very volatile right now. And we pulled up this risk-reward range right here, and it closed right in its weekly expected move. There was no doubt about it. It bounced off its 50-day moving average after breaking above it. So it was like it left a gap, right? So it gapped up above its 50-day moving average. It came down, it back tested that 50-day moving average, and then it bounced off of it, giving us this nice rally, 3-session rally after this nice bounce off of a back test. That's the type of things you want to see. And bouncing off of the back test, that's when you want to enter. So entering there, you probably would have entered somewhere around 76, and it closed at around 79 today. Now, the advanced decline line, it was heavily favored to decliners today. Obviously, with the market being down, decliners led advancers by nearly a 6-to-1 margin at the New York Stock Exchange and a 10-to-3 margin at the NASDAQ. So you can see that technology really got beat up today. Now, Germany's hotter than expected PPI report, it affected the Treasury market today. The 2-year yield rose 3%. We can look at that. US 0 to Y, and you can see that resistance line and how price action was today. Let's fix this a little bit. So yesterday it was rejected from that resistance line. Today it bounced back up. But it closed today at 3.25%. It was unchanged for the week. In the after hours, it's 3.24 right now. So slightly lower. Now the 10-year was flirting with 3%. But it rose 11 basis points on the day and 14 basis points for the week to 2.9%. We can look at that. US 10Y. And you can see this rally that's been on, which is a good thing. Right now, even though it can have a negative impact on technology, we want to see the 10-year rise and we want to see the 2-year fall. The reason why is we want to get out of this inverted yield. This inverted yield curve, we need to get out of it. Today was a step in that direction. Banks financials, financial sector doesn't like an inverted yield. Doesn't like it when short-term bonds are paying more than longer-term bonds. It's supposed to be the other way around. Now, there was no real big economic data of note today in the US. So, ladies and gentlemen, that takes me to wrapping up all of my notes. If you have any other questions, plug them in. Otherwise, do me a favor, click that like button, share this video with a friend, and join our investor community by clicking on the first link in the description. You'll get instant access to our weekly expected moves, numerous trade setups in 13 different styles, 10 or top 10 stocks list in 4 different categories, and economic and market insights, all to help you along your investor journey. Gaining knowledge is all we're doing. And as you gain that knowledge, you become a better investor, a better trader to achieve your financial goals. All right. Thank you. Looking forward to Sunday. Email. Absolutely. Absolutely. I will have a note going out tomorrow on Saturday. And that note is taking a few steps back, looking at a bigger picture for where we are and where we're headed. So don't miss the Saturday email that comes out or the Saturday post for Patreon. And definitely don't miss the Sunday post on Patreon or email from Patreon from that post for the weekly expected moves, so you know where the market is headed in the week to come. Okay. Thank you. You are welcome. I greatly appreciate all of you joining me, spending your time with me. I love it. This is like one of my favorite things to do. Top 10, top 5, top 3, maybe even top 2. But my kids and my wife, they probably hold the top 2 sections, and then this is probably my top 3rd. So I love doing it. I love engaging with all of you. I love the questions, and figuring out this investor journey is wonderful. Okay, so thank you, and I'll see you guys live again Monday after the market has closed. And of course, watch out for the Sunday weekly expected moves post on Patreon, and also on Saturday, the kind of bigger view of what's going on in the market and where we're headed. That's going to be posted tomorrow on Saturday on Patreon. So if you want access to that, just click the first link in the description. All right, have a wonderful weekend, and I will see you in the next video.